Hello, today we are going to be discussing my capital budgeting simulation as the CEO of the New Heritage Doll Company. So, first we're going to look at how I evaluated the diverse set of competing investment proposals and made decisions regarding the 27 proposals over 5 years. So over the 5 years, I chose 21 out of the 27 projects. 8 of these were production projects, 8 were retail, and 5 were licensing. So you can see the projects that I chose here. And the way that I chose all of my projects was based off of one number in particular. So I looked mostly at my APV, or not at my APV, at my terminal value. So my terminal value is right here, and basically what the terminal value is the present value at a future point in time of all future cash flows when you expect a stable growth rate forever. And this uses the stable growth model, which assumes that cash flows are reinvested, which they are in the simulation, and it also assumes that the firm can grow at a consistent rate in perpetuity, which we also assume here, given that we show projections for up to 10 years in the future with different projects. So when you're projecting so far into the future, it's a rule of thumb that you have a terminal value of around 50 to 60, and so I always tried to adjust my terminal value by using this discount rate right here, and it would affect your terminal value as well as it would usually increase your internal rate of return, which has to do with your debt. And so I would always make sure, as well as having a terminal value around 50, I would also make sure that my IRR was higher than my NPV. And I would also look at these numbers down here. So I would look at the total for the cash flow statement and make sure that it was increasing over the years. And then I would also come down here and look at the ending cash balance and make sure that it was increasing. So for this expansion to England, it didn't increase at an insane rate or anything, but let's see if we can find a project where it did increase. So this one, you can see it increased at a greater rate here and here. So those are the numbers that I looked at when doing this, when evaluating the projects. So there was a range of projects. Obviously, there were production, retail, and licensing. There was only one example of a mutually exclusive project, which was found in 2011. So I'll go to a project or a run that hasn't been completed yet. And so if you look here in the Decide tab, these little crosses mean that they're mutually exclusive. So our options was either to choose acquisition of electronic toy manufacturer or acquisition of a children's magazine. I ultimately chose this option. Looking at these numbers right here, even, it is a better option. It has a higher NPV, a higher IRR. It has a higher profitability index, and it has a lower payback period. So just based off those numbers alone, it made more sense. But if you click on the details, it has an insanely high terminal value, and it is a high risk. Even with the percentage being set to match its division and to match its risk, which is 9%, it's still at a terminal value above 100. And the rate that these numbers down here increase is just very high. So I ultimately decided to go with the acquisition of the children's magazine, if I can find it, this one, because it was already in that range that I preferred, and it had a more steady rate of return here and here. As for looking at interdependent projects, you will see if we look at project updates. Oh, I'm still on the wrong run. Let's go back to here. In 2010, we had 2 projects offered to us. Well, we had several objects, but 2 of the projects that were offered to us were the Dolls of the World initiative and then expansion of the mail catalog business to Asia. So it's right here, Dolls of the World, an expansion to Asia. So these projects go hand in hand with each other. Well, one is retail and one is production. Retail and production often do go together because your products, production, are what you're selling in retail. So I chose these projects because as we're becoming more inclusive with where our business is at, we want to be more inclusive with what our products are that we're selling. And so this came into play again later, 2 years later, in 2012 when we expanded to England. And so the Dolls of it also was played into the Dolls of the World initiative. So then how I examined expenditures using common metrics such as NPV, IRR, and the payback period. I kind of already mentioned this, but basically I would make sure that my internal rate of revenue or internal rate of return was always higher than my net present value, which it usually already was for projects that I would choose, but I could adjust that by adjusting this number right here. Oops, nope, wrong thing. 6.6. So you can see right here that made my internal rate of return go down lower than when the discount was lower. So that was how I achieved that. And then how I explored the problem of resource allocation by looking at projects from a senior management perspective. As I already mentioned, I chose 21 of the 27 projects. 8 of these were production, 8 were retail, and 5 were licensing. I think it makes sense that I had the same number of retail projects as production projects because, as I mentioned, production and retail go hand in hand. So when you look at revenues, production and retail are pretty much equal. Licensing has less, and then also when you look at assets in production are equal to assets in retail, with licensing being the least. But then when you look at the operations profits, licensing is 50% of that, whereas production and retail are far lower at 30 and 20%. So I think that basically goes to show that you don't need as many licensing projects because they have more value typically. So you don't need as many of them. And since they are typically seem to be less common products, they actually, I think when they happen, do tend to be more successful and maybe even have an increased popularity. Moving on to the impact of capital rationing on investment. Basically, this is how your budget affects your ability to make decisions. I think it's all about your strategy because in the beginning we had an unlimited budget and my APV, rather than being this high, was only about 500 or so, and I had a completely unlimited budget. And then I tried again with the scenario C, which is the next scenario, and I still only had an APV of about 500 by doing the same strategy, and it's because I had a limited budget, so I couldn't select as many projects. So I think that just goes to show that your budget can, yes, affect it, but even with an unlimited budget, since I hadn't developed my strategy yet, I still couldn't achieve the APV. So I think it's mostly about your strategy. And then I already mentioned how I adjusted, I adjusted my projects by changing this percentage. I did that with almost every single project I chose, unless, like I mentioned with the acquisition of the children's magazine, it was just already in the right range, so there was really no need to change it. Okay, and lastly, I want to look at how capital budgeting rules significantly influence the company performance and market position. So, based on the projects that I chose, this determines where I'm at in the market. So your capital budgeting determines how many projects you choose. So you can see for the first 2 years I chose 4 projects, but in 2011 I only chose 3. And that was because in that year the projects that were available, so many of them had a terminal value of 0, meaning that they weren't going, in the future, they weren't going to have any value. So I didn't want to pick those. So that affected how many projects I could choose based on my capital budgeting strategy. It also can limit how many projects you choose based on your budget. So for this one, I think it shows you in the dashboard. That was my budget. And so I had a way higher budget than in other scenarios, and so I could choose more. When I moved on to scenario C, which you can see here, it basically, let me go. I had a lower budget, and I think it'll show you. Yeah, that was my budget available. It was far less, and look at how low that APV is. Now this is, of course, this one was the last run that I was just showing you, so it was just, I clicked through it so I could show you the examples in 2011, but it has such a low APV because I didn't have the budget to select as many projects as I did in this scenario. So yeah, and based on my strategy, it affects what I would choose. I wouldn't choose any projects that weren't going to have a value in the future. And like going back to the interdependent projects, I would try to choose projects that had to do with each other. So especially the greatest example was the Dolls of the World with my expansions to Asia and to England in 2012. As well as we had the Bookstore Writers Club, and then later you have the Young Authors book series. That's another example of things that went together, so it made sense to pick both, and they also fit my criteria. So that was how I did my simulation and how I ended up with the overall APV of 939. It was, again, just simply focusing on that terminal value, which would increase my internal rate on return, which affected my debt. So I had low debt and high value, and that's how I got this high APV. So that's how I did it. Thanks for watching.